Okay, good morning, everyone. Well, the calm in some markets, notably the FX market, while the storm rages around it, is really remarkable. European equities closed lower across the continent yesterday, and U.S. stocks were off over 1%, while the new one-month T-bill came at a remarkably high yield of 0.35%, the highest yield since 2008, and really an astonishing increase from the 0% at last month's auction. On the other hand, yesterday's new 3-year bond came through the market, and the dollar remains remarkably stable. In fact, the dollar was steady or gained against all its G10 counterparts yesterday. Apparently, the markets are worried about the Treasury's ability to pay its debts short-term, but aren't putting much weight on the possibility of a lasting disruption, as demonstrated by the odd curve in the money market. The one-month yield on the T-bill is sharply higher than all months, and the curve is inverted out to 4 months. I think investors remain optimistic about the likelihood of a last-minute resolution of the problems. That would explain why only the shortest bills maturing around the October 17th deadline have been affected. But they also realize that these shenanigans in Washington can have a lasting impact on business and consumer confidence in the government, which explains why the impact is concentrated in the stock market. In that case, the problems in emerging markets might take a lot longer to heal because U.S. growth could take a hit for some time. In fact, the IMF yesterday downgraded its estimate for global growth for the 6th time in a row. At the same time, slower U.S. growth also implies that U.S. rates are likely to remain lower for longer than expected, which should be good in the long run for risky assets and specifically the risk-sensitive currencies. That possibility, in fact, gained a boost overnight from news that President Obama will, as expected, nominate Janet Yellen later today as the new Fed chairman to replace Mr. Bernanke. As one of the main supporters of the policy of quantitative easing and a confirmed dove on rates, Ms. Yellen is likely to prefer to err on the side of caution in moving to a tightening policy. That bodes well for the high beta G10 currencies once we're through with this debacle. But in the short term, the risks of a policy step in Washington are still very high in my view, and I expect the flight to safety trade to dominate. I think being short trades like Aussie Yen and Kiwi Swissy will become more profitable as the discussions go down to the wire and even over the wire, perhaps. For more details, including a discussion of today's indicators and their likely impact on the market, please see the full comment on our website, www.ironfx.com. Or like us on Facebook, follow us on Twitter, and subscribe to us on YouTube. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.